The financial system doesn't collapse because of news. It collapses because invisible money flows reverse direction. Right now, a $200 trillion engine is malfunctioning. Japanese government bond yields are rising, the yen is strengthening, and the carry trade is reversing, sending shockwaves into the United States. What will break first when Japan pulls $1 trillion out of America? This is what 99% of investors are not seeing. In the next 30 minutes, you'll understand the hidden mechanism behind this crisis, see who gets hit first, and learn the exact signals to watch over the next 60 days. Let's begin with what most people missed. To grasp what's happening now, you have to go back 30 years. In 1990, Japan's real estate and stock market bubble burst in spectacular fashion. Property values plummeted, banks collapsed under bad debt, and the economy entered what would become known as the lost decades. To prevent further deflation and stimulate growth, the Bank of Japan slashed interest rates to near zero and kept them there for 3 decades. This wasn't a temporary policy response, it became permanent infrastructure. Japan became the only major economy to maintain interest rates at essentially zero through every global cycle, through the dot-com crash, through the 2008 financial crisis, through the European debt crisis, and straight into the COVID pandemic. This created an anomaly in global finance, a giant pool of money available at virtually no cost. And where there's an anomaly, there's opportunity. The carry trade was born out of this distortion. The concept is simple. Borrow yen at 0% interest, convert it into dollars, and invest in higher-yielding assets in the United States or elsewhere. You could earn 4 to 6% returns without taking what appeared to be any real risk. A pension fund in Canada once made billions of dollars every year using this exact strategy, borrowing yen, buying US Treasury bonds, and sleeping soundly. It wasn't speculation, it was arbitrage. It was free money, and everyone knew it. But here's what nobody's telling you. Over time, the carry trade evolved from a niche strategy into something much bigger. It stopped being just a trade and became infrastructure. Cheap yen didn't just flow into Treasury bonds, it flooded into private equity, fueled the artificial intelligence boom, propped up big tech valuations, suppressed mortgage rates across America, kept US Treasury yields artificially low, and created a widespread illusion that liquidity was infinite. Entire sectors of the economy began to rely on the assumption that capital would always be cheap and abundant. Silicon Valley wasn't just built on code and innovation, it was built on 0% yen loans. Venture capital firms, leveraged buyout funds, real estate developers, and even retail mortgage borrowers indirectly benefited from this flow. A software engineer in Austin just saw his stock options lose 40% of their value in 3 months. He doesn't know it's because of Tokyo. But you do now. Many of the valuations we see today don't rest on fundamentals, they rest on artificially cheap capital. The price of risk was suppressed because the cost of borrowing was suppressed. And as long as Japan kept rates at zero and the yen stayed weak, the entire system could keep running. That era just ended. Japan is raising interest rates. After 30 years, the Bank of Japan has begun tightening policy in response to rising inflation and pressure to normalize monetary conditions. As Japanese government bond yields rise, the yen strengthens, and when the yen strengthens, every yen-denominated loan becomes more expensive to repay. Investors who borrowed cheap yen are now facing a brutal calculus. They need to pay back those loans in a currency that's gaining value. To do that, they have to buy yen. And to buy yen, they have to sell dollars. And to get dollars, they have to sell US assets. The math is brutal. This isn't a choice, it's forced selling. Positions are being liquidated not because fundamentals changed, not because earnings disappointed, but because the cost of leverage just exploded. Tech stocks, cryptocurrencies, corporate bonds, private credit instruments, even US Treasuries themselves are all being sold at the same time. Nobody is selling because they want to. They're selling because they have to. A fund manager in New York was forced to liquidate $200 million in tech stocks within 3 hours because the yen appreciated by 1.7% in a single session. That's not panic, that's math. When leverage unwinds, it doesn't ask permission. And it's not just about individual trades unwinding. Japan has been the largest foreign buyer of US Treasury bonds for the past 20 years. Japanese institutions, particularly life insurance companies and pension funds, have accumulated trillions of dollars in American debt. But now, Japan is becoming a net seller. There are several reasons for this shift. First, hedging costs have surged. When Japanese investors buy dollar-denominated assets, they typically hedge their currency risk. As the yen strengthens and volatility increases, those hedges become prohibitively expensive. Second, domestic yields in Japan are finally rising, making it more attractive to invest at home. Third, there's political and strategic pressure within Japan to repatriate capital and strengthen the domestic economy. Fourth, Japan needs a stronger yen to bolster its geopolitical and economic resilience in an increasingly unstable region. The result is a cascade of consequences. US Treasury yields are rising as one of the largest buyers turns into a seller. Higher yields mean a higher cost of capital across the entire American economy. Equity valuations compress because future earnings are discounted at higher rates. Collateral values weaken, triggering margin calls and further forced selling. And liquidity, which seemed infinite just months ago, vanishes. What looked like a stable, self-reinforcing system is now unraveling in reverse. But here's the part that keeps institutional investors awake at night. This isn't contained to one asset class. The contagion is spreading across markets and geographies. In technology, companies that poured billions into artificial intelligence infrastructure are discovering that depreciating assets like AI chips don't support lofty valuations when the cost of capital rises. In crypto, where liquidity is high and leverage is rampant, assets are being sold first because they're the easiest to liquidate. In private credit, credit lines are being shut down suddenly, leaving borrowers scrambling. In Europe, sovereign bond spreads are widening, raising fears of another debt crisis reminiscent of Italy and Greece. And in emerging markets, the impact isn't a slow decline, it's structural fracture. Countries that rely on dollar inflows and cheap global liquidity are seeing capital flight, currency devaluation, and economic instability all at once. Liquidity isn't local, it's global, and when it reverses, nowhere is safe. What makes this especially dangerous is the feedback loop. Rising Japanese interest rates strengthen the yen. A stronger yen makes yen-denominated debt more expensive. More expensive debt forces the sale of US dollar assets. Selling dollar assets weakens the dollar. A weaker dollar strengthens the yen even more. And the cycle accelerates. This isn't linear, it's non-linear. Small moves compound into large moves. What starts as a 1% currency swing can trigger a 10% sell-off in equities. The system amplifies itself in both directions, up and down, but when it's unwinding, the speed is brutal because there are no natural buyers left. Everyone is selling at the same time, and liquidity dries up entirely. No one is safe. And just when you think it's purely a financial story, geopolitics enters the equation as an accelerant. Japan has publicly committed to defending Taiwan in the event of Chinese aggression. This isn't a hypothetical anymore, it's official policy. China has responded with economic pressure and strategic threats. In this environment, Japan needs a strong yen not just for financial stability, but for national security. A strong currency increases purchasing power for energy imports, military equipment, and strategic reserves. It projects strength and resilience in a region where perception matters. But strengthening the yen accelerates the carry trade unwind, which accelerates forced selling in US markets, which destabilizes the very financial system that underpins both American and Japanese security. Geopolitics isn't an external factor in this crisis, it's a catalyst. It's the spark that turns a slow burn into an inferno. What we're witnessing is the collapse of a 30-year assumption. For 3 decades, the global financial system has operated on three foundational beliefs: that interest rates in Japan would stay low forever, that liquidity would remain infinite, and that Japan would always be a net buyer of US debt. All three of those assumptions are now false. And when the foundation shifts, every model built on top of it has to be rewritten. This isn't a market crash in the traditional sense. Crashes are violent but temporary. This is a structural recalibration. The architecture of global capital flows is being rewired in real time, and most people don't even realize it's happening yet. So what does survival look like in this environment? It comes down to three core principles. First, liquidity is survival. In a forced selling environment, the assets you can sell quickly matter more than the assets with the highest potential return. Cash and cash equivalents become the most valuable holdings, not because they generate returns, but because they give you optionality when others have none. Second, flexibility is resilience. Rigid strategies break. Diversification across asset classes, geographies, and time frames allows you to adapt as conditions shift. The investors who survive aren't the ones with the best predictions. They're the ones who can pivot when their predictions turn out wrong. Third, visibility is advantage. Understanding how money flows through the system, where leverage is concentrated, and which dominoes are connected gives you the ability to move before the crowd. Most people react to price. Smart money reacts to flow. Now let's make this practical, because understanding the problem without knowing what to do is worthless. If you're an average person, not a professional investor, here's what you need to do right now. First, avoid using leverage. Borrowing to invest amplifies gains in good times, but it destroys you in bad times. Right now, we're entering bad times. If you're using margin in your brokerage account or taking out loans to buy assets, stop immediately. Second, keep 6 to 12 months of living expenses in liquid, accessible cash. This isn't pessimism, it's prudence. If markets freeze or your income is disrupted, liquidity buys you time. Time is the most valuable asset in a crisis. Third, resist the urge to chase the latest tech stock or crypto narrative based on headlines. FOMO kills portfolios in volatile environments. The assets that look the most exciting right now are often the ones with the most hidden leverage and the least liquidity. Fourth, if you own a home with a variable rate mortgage, consider refinancing to a fixed rate now before borrowing costs spike further. Fifth, review your retirement accounts and make sure you understand what you own. If your portfolio is heavily concentrated in high-growth tech or speculative assets, consider rebalancing toward more defensive positions like consumer staples, utilities, or short-duration bonds. If you're a small-scale investor managing your own portfolio, you need to become a student of flow, not just price. Start watching the 10-year Japanese government bond yield every day. You can find this on Bloomberg, CNBC, or TradingView. When it spikes above 1% and stays there, that's your early warning signal that Japan's tightening cycle is accelerating. Watch the cost of hedging between the US dollar and the Japanese yen. This is measured by the cross-currency basis swap. And when hedging costs explode, it means capital flows are about to reverse violently. You can track this through financial news or specialized platforms. Rank your assets by liquidity risk. Ask yourself, if I needed to sell this position tomorrow, could I get a fair price, or would I have to take a massive discount? The assets that would require discounts are the ones you should reduce or eliminate now. Build a watch list of stocks and sectors that are most vulnerable to rising interest rates and forced deleveraging. These include high-valuation tech stocks with no earnings, crypto-related companies, real estate investment trusts, and anything in the private credit space. When these start breaking down, it's a sign that the unwind is accelerating. Finally, don't try to time the bottom. In forced selling environments, prices can fall much further than rational analysis suggests, because sellers aren't choosing to sell, they're being forced to sell. If you're a business owner or entrepreneur, this environment demands three things immediately. First, reduce fixed costs wherever possible. Flexibility in your cost structure gives you breathing room when revenue becomes unpredictable. Renegotiate leases, shift to variable compensation structures where appropriate, and cut any expenses that don't directly contribute to cash flow. Second, build cash reserves aggressively. Companies that survive downturns aren't the ones with the best growth stories, they're the ones with the strongest balance sheets. Target at least 6 months of operating expenses in liquid reserves, and if you can push that to 12 months, do it. Third, do not become dependent on short-term debt. Credit lines that seem reliable today can vanish overnight when liquidity dries up. If you have existing short-term debt, work on extending maturities or paying it down entirely. Fourth, communicate transparently with your team. Uncertainty breeds fear, and fear leads to talent flight at the worst possible time. If you're making defensive moves, explain why you're doing it and how it positions the company to weather the storm. Fifth, look for counter-cyclical opportunities. When everyone else is in panic mode, businesses with strong balance sheets and clear thinking can acquire assets at deep discounts, hire exceptional talent that's suddenly available, and position themselves for the next cycle. What should you be watching over the next 30 to 60 days? 4 signals matter most, and you need to track all of them. First, watch for spikes in Japanese government bond yields, especially at the 10-year and 30-year maturities. If yields break above 1.2% at the 10-year and stay there for more than a week, it means Japan's tightening cycle is accelerating faster than markets expected. This will trigger more carry trade unwinding. Second, watch the dollar-yen exchange rate closely. If it breaks below 140 yen per dollar, that's a psychological and technical threshold that will trigger massive, forced selling. Currency traders use this level as a key reference point, and once it breaks, algorithmic trading systems and stop-loss orders will amplify the move. Third, watch U.S. Treasury yields, particularly the 10-year. If the 10-year yield pushes above 5% and stays there, borrowing costs across the entire economy will spike. Mortgage rates will surge, corporate refinancing will become prohibitively expensive, and equity valuations will compress sharply. Fourth, watch the private credit market for signs of freezing. You'll see this in news reports about deals falling through, credit facilities being pulled, or funds gating redemptions. When private credit freezes, it means the liquidity crisis has moved from theory to reality, and it will spread to public markets within days. Here's what you need to understand about timing. You can't predict the exact moment when this accelerates, but you can see the warning signs building. Think of it like watching a dam develop cracks. You don't know which crack will cause the failure, but you know the pressure is building and the structure is weakening. The smart move isn't to wait until the dam breaks, it's to move to higher ground while you still can. Right now, we're in the crack formation phase. Some investors see it and are already repositioning. Most don't see it yet, and they'll react only when the water hits them. The question is, which group you want to be in? Let me bring this all together because this is the moment that will define the next decade of your financial life. Liquidity is reversing after 30 years of abundance. The carry trade that funded everything from Silicon Valley to your neighbor's mortgage is unwinding. Forced selling is spreading across asset classes and geographies. Geopolitical tensions between Japan and China are accelerating the process, and a 30-year system built on cheap Japanese capital is being reset in real time. This isn't speculation, it's happening now. The data is visible if you know where to look. The mechanism is clear if you understand how flows work, and the consequences are inevitable unless something dramatic changes the trajectory. The financial system you grew up with, the one where central banks always provided liquidity, where risk was always rewarded, where markets always bounced back quickly. That system is over. What comes next will be different. It will reward discipline over speculation. It will reward liquidity over leverage. It will reward those who understand flows over those who only watch prices. The winners in the next cycle won't be the ones who predicted every twist and turn. They'll be the ones who prepared, stayed flexible, and had the resources to act when opportunities emerged. So here's my final question for you. Will you react after the shockwave hits, when your portfolio is down 30% and your options are limited? Or will you prepare now, build your defenses, understand the warning signals, and position yourself to be one of the survivors in the new system? The era of free liquidity is gone. The era of disciplined intelligence begins now. You've just seen what 99% of people are missing. What you do with that information in the next 48 hours will determine whether you're part of the solution or part of the wreckage. Start by checking your portfolio exposure tonight. Look for leveraged positions, look for illiquidity, look for concentration risk. That's step one. Everything else follows from that. The choice is yours, but the clock is ticking.